Good afternoon and welcome to this week's edition of Halftime Talk. I'm delighted to be joined by Richard Redoglia, CEO of Matrix Global Holdings, joining us from California. Richard, thank you so much.
Sean, thank you very much for allowing me to be on today's show.
Richard, there's been obviously an incredible run in the oil markets from ultimately minus $40 in WTI last April in a very sort of freakish moment of what created perhaps the biggest shock in the oil market through this crisis, to now where we're comfortably sitting above $70 a barrel. A lot of that period seems to have been from the period of minus 40 up till recently, driven a lot by sentiment rather than fundamentals. And I'm wondering, I'd like to kick off with you today to talk a little bit about your review of the market structure over recent times and what it's telling you. And particularly, this is a market in which it's been a battle of managed supply versus demand. And I'm wondering, from your perspective, who's been winning? Where is demand in all of this?
I think, thank you, Sean. I think, I went back, as I said, I kind of listened to some of the people who have been on this podcast over the past 6 to 8 months and listened to their approach and listened to what they had to say. Mike Muller of Vitol, the head of Saudi Aramco Trading, Selected Slate from Abu Dhabi, and really looking at and listening to what they were saying. And you said it many times. You kind of said, this is like the Federal Reserve now with Alan Greenspan. And so when you look at the market, you talk about this managed supply and managing supply. It makes me think of the history of where we've come from and really what we've done. And I think we'll have a couple of slides, not some of those we're looking at now, but some slides that we'll see later.
This is your first slide that we currently see on the screen. Perhaps right. You can talk us through it.
I think to me it's a fascinating slide because it really shows something that we've never really seen in the oil markets before, right? And when you say something like that, people immediately say, well, that's I'm not sure I agree with that. But I think what it shows is there's only one thing about demand. Demand is always going up. There are periods of demand where it slows down for maybe a quarter or two, and that's why the line on the left kind of is a sine wave from bottom to top. But it was only really a period of
what time period is that?
This is 1990 to 2023, and it really shows the only significant increased demand was during the 08-09 recession. And it was that period of time, we saw demand fall around 3.5 million barrels a day. The price of oil went from $140, if you remember, all the way down to $27. But it was a function of really a demand shock, right? And everyone was moving along pretty happily. The market was moving up strongly. The prior 6 years had seen a significant increase in Chinese demand, which was kind of met with no new production coming online. I think one of the things that's ironic when I've gone back and looked at data and looked at how markets behave, particularly in the United States, the lowest oil production in the United States was 5.7 million barrels a day, which was October of 2008, which was a month away from the highest price ever. So that's not coincidental. That is something that shows that marginal supply plays a very strong role in how oil prices behave.
It's interesting to reflect on that even during those boom years of the 2000s of $100+ oil, that it wasn't sufficient to bring shale and all of that into the market.
It didn't exist. I mean, we knew how to frack. We knew how to frack. We didn't know how to horizontally frack, and really that was the key. And so what we had was an unabated pressure. OPEC. In fact, when I went back and looked at OPEC production over this period of time, I think it was from 2004 to 2014. It fluctuated. It's 28, 29, 31, 30, 29, 30. It's just this very minimal fluctuation, which is why it's so important to look at the chart here. We saw demand drop 3.3 million barrels, But my company, Matrix Energy Horizons, was the first company to ever develop a derivative for oil storage capacity. So we've been auctioning off storage capacity at Loop in the United States. We did it for oil tanking in Copenhagen, and for products, and we have a couple other projects that we are working on. But when you look at price, to me, one of the greatest things to look at is, what it reflects itself is in the shape of the curve, contango and backwardation. That really shows you at a moment in time what is demand and how much is demanded right now. And what's interesting about the charts I put up here is that in the period where we saw demand drop down by 3.3 million barrels, it took about 2 years to get back to the same demand level. Okay, so we went from, you can see the red line and the blue line, 2 years peak to peak. Now go over to the next chart. There, that is the front to back month WTI calendar spread. And what it is showing, that going into the recession, so we're talking about August 2008, prices 140. Goldman had given its famous $200 call, which put the top in right there. The market started to collapse. We started to see weakness. We started to see the mortgage crisis hit. And at that point, the crude spread, I think if I have to go, I can't really eyeball it there, but it was probably about $6 in backwardation. Well, look what happened. You can see the market went from $6 in backwardation to a collapse that was significantly, and I have my bigger charts here, went down to $12 contango. So it shows kind of exactly what we've seen before. Markets react, but when they react, they don't just move into, they just don't see a lower price. They see a complete destruction of demand, which causes the oil, which is flowing, with nowhere to go. And that's where all the oil traders make significant money, because they're so quick and they're so fast at the ability to gather the storage and store it. So that's a 5.5 year period. That's a long period. And to me, what we're seeing now is really the most remarkable thing that I've seen in my decades of watching these markets. Here, we go back to the red line, go back to the side, and you see demand fell 15 million barrels. We saw someone talking about that on your show earlier, I think it was a couple of days ago, talking about how great the demand fall has been.
And that second slice you're working at now is last year, essentially.
Last year, and demand fell. In fact, talking to listening to the speech from the chairman of ATC, he talked about how quickly they had to change behavior. The oil was flowing. It's not stopping. It's coming out. It hit jet fuel first, but very soon after that, it hit the refineries as everyone turned back barrels back to the producers. But it caused a significant demand collapse. And we see that in that data. What is remarkable, given the fact that demand has not just fallen 15 million barrels, it has not reached its peak yet, right? So it didn't reach its peak. We're still, right? We all agree we're still about 5 million barrels below where we were last year. Everyone's always talking about when do we get back? How are we going to get back to it? But notice, going back to the chart on the right, the ability of the crude spread to go from where it was to where it is now. And I think it went from $5 in backwardation to, as we know, $47 into contango. It's now $5 into backwardation again. It took just a year for that to happen. Why is it? That's the question. Why? And I think the why is, and you have been on this since I've been listening to you for a while, but listening for the last number of months. We're on it because we're managing supply. And you mentioned in the opening here, what's more important? Is it managed supply? Is it demand? It is the combination of both. And
but in this instance, in 2008-9, to a great extent, the market managed its way back to equilibrium. Obviously, there was reaction, but the essentially from the backwardation posture, minus $5. On this occasion, like the Fed, it has been jawboned back to accelerated equilibrium.
No, it's been more than jawboned. We're talking now about 5-year averages now. We're talking about, we're seeing 100 million barrels. I think Mike Muller had said in one of his most recent speeches, and then his excellency, I can't say his last name, from UAE, he said, we've gone from quarterly meetings and biannual meetings to a monthly meeting. And I think it's that acceleration, right? It's the acceleration of the ability to meet and adjust in real time, where we're now talking about what's the next meeting going to be.
Is that a sustainable posture, do you think, or is it just a medicine for now?
You tell me. You know, I think, Sean,
I mean, we've been here before on that point. I mean, I remember covering the oil markets as a journalist back in the late 90s when the price collapsed to $10 a barrel. And His Excellency Ali Al Naimi was the Saudi Arabian minister at the time. And under his leadership, the organization moved to a sort of regular meeting posture. I don't know if it was quite monthly, but it was certainly every 2 months. For a period of 2 years, maybe 3 years, in which they successfully lifted that price up to the sort of mid-20s, and that was deemed an amazing success. But they weren't able, or they didn't appear with desire to sustain that sort of tight micromanagement beyond that.
Well, then you ask yourself, okay, then we ask ourselves, what are the differences then? The major one is we have Russia involved now, right?
Yes.
Non-OPEC players involved. I think that's first off. Second is the information flow is so much greater. I think that's a tremendous amount of information. Again, I said this in one of the podcasts on the Daily Wire. We didn't have Genscape. We didn't have Kepler watching every cargo move out of every port every single day. We didn't have the ability to look at jet fuel demand in real time at every airport in the world. We can't watch car traffic every day in every location. And given the fact of computer speeds going on, you know, there's so many things that we've experienced over it's a different world, you know.
I mean, it strikes me that this phrase, it's not a recovery, it's a rebound. The idea that it's somehow a spring, that somehow what we're seeing with all of this explosion in consumer demand, housing prices, lumber prices, everything is in this sort of spring rebound. The kind of, you throw a ball against the wall and the first meter or two, it's coming at great velocity, but then it drops off pretty quickly. And in a lot of ways, it feels to me like this oil market has been jawbone to this accelerated recovery posture, but you literally need all the force to keep it in play. And I'm wondering your thoughts on that.
Well, let's go to a couple. Let's look at another chart here. The next chart, I think, is an interesting one. If you can put that up. Here's what when you asked about this something today, or about looking at something technical, I found this was interesting. Look at the trend line. Look at the trend line from bottom to from bottom to top. The bottom trend line. Notice it from 12, the low of 2014, which was, by the way, was 27.25, which was exactly the low of the 08 move, and the low of 2014 were off by 10 cents. So we can talk about charts being important or not important, but that's a pretty good double. That was a pretty good double bottom right there. What's interesting about this is connecting it to, if you just kind of forgot about 2020 and said, you see the two arrows there, the one blue arrow where the collapse started in the first quarter when the pandemic hit, and this recent one when we saw, I think that second arrow was when Saudi said, hey, by the way, we're going to keep another 1 million barrels out of the market. So my question is, and I don't have the answer to it, is this the new trend line? Is this the kind of the trend line we should be watching? And this is the crude spreads, right? You can see how these crude spreads have traded. Let me see. There's one more I'd like you to go to, and go that one there. So this is spot continuation. Look at this. This is the same thing. We are finding ourselves. You just asked a question, Sean. I think you said, can it last? Well, when we're looking at charts and we're asking ourselves, what's driving it, and what's the longer term trend? Two major things have happened here with this chart. One is, you can see at the very bottom, the moving average. When a 50-day moving average moves above a 200-day moving average, it really portends a long-term trend is starting. And that started at the end of 2020. So, do we have more room to go? Well, that moving average says we do. The second
upward,
yes. The second one is the momentum, the speed at which something is going. Can it maintain that speed? And usually when markets get overbought, they correct and they go sideways for a little bit. Well, you can see,
which we saw in the 60s for 2 or 3 months.
Absolutely, we've seen it multiple times in
sort of like mid-February to mid-May, or it sort of sat in that space.
So you can see here, we have the ability for our momentum to continue. Our moving average is not even past the 0 point, so it's crossed and heading up. And then you can see the long-term trend line going back to 2012. So we're at an inflection point. We're right there. I mean, if it gets,
well, we're literally nearly there today, where this week the Fed are meeting to discuss their thinking about tapering off this incredibly loose policy they've been running. OPEC are meeting in 2 weeks' time to thinking about more action about stepping back from their very tight control of this market. Exiting out of these very managed positions is really the big challenge to come. This rebound versus recovery. If it was a recovery, you'd sort of let the economics take its course. In a rebound, you've got to interject, you've got to extract yourself. How do you see that going in the context of the market, the oil markets?
So I think something else that's fascinating about this, to me, is almost, it's amazing that I never thought we'd be saying this. We've always talked, I was a peak supply guy back in the 80s. Oil is going to go around oil. That was wrong. And maybe I'm wrong now, maybe the peak demand. But what's amazing is that this acceleration of ESG, of the environmental focus and where money's going. Money's been very cheap, you're right. Money has been an extremely cheap asset over the past 12 years, 13 years, if not longer. And that has led to a massive expansion in the midstream sector. We've seen huge storage facilities built around the world. We've seen pipelines built everywhere. We've built this huge infrastructure for oil. Well, now we were just told by the IE, don't invest in oil anymore. Don't build any more oil. We're going to be carbon neutral by 2050, and we're going to stop using oil at some point in the next decade. ExxonMobil just lost a massive court case. Shell's being sued into being forced to reduce its carbon footprint. What does that mean? What does it mean when an oil company has to reduce its carbon footprint? And OPEC itself is being told, we don't want your oil. So I don't know the answer, but I do know that those words have never been said in my life, where we're passing a torch and saying, hey, we're not going to invest in oil, even though we're oil companies. Oil demand is starting to rebound. We have another 5 million barrels to make up, which allows Iran to come online, which allows maybe a few more fracking barrels to come online. It allows UAE and Saudi to increase. But the question becomes, what is OPEC going to do? Is MBS and his minister, are they the new kind of Paul Volcker that they're really going to manage it? Are they really going to say?
It strikes me that when you think about the combination of the two things coexisting through COVID, we've got an accelerated emergence of the energy transition and its priority in the terms of Wall Street, perhaps more than anywhere. Policymakers somewhat catching up, but really investors seem to be the most activist in ways. You have policymakers coming into with Biden administration, but at the same token, you still have a majority of the world's power generation created by fossil fuels. Global fossil fuel use is similar today as it was a decade ago. There's reality, and then there is the headlines, in essence. Right. And there is a chance that the world might get that wrong, and with it to create its own shortage in fossil fuels in the coming 24 months.
I'm leaning towards that. I'm thinking that the world is, I don't understand why they believe that stopping oil production is somehow going to stop climate change at this time. I've said this time and time again in arguments of friends who we have different views on life. To me, the most regressive thing you can do for people who have less is to raise the price of energy. It is the number one thing that hits people in their pocketbook every single day, every single week. And here in California, I paid $4.99 for gasoline. You know, San Diego, I live in San Diego, California, lovely place. Everything's great about it, but it has the highest gasoline prices in the United States because there's not a refinery nearby, but it has strong demand. And so you just said it. Why? I mean, there's this kind of disconnect that's gone on. I'm not sure if you're aware that I think we've seen, I was going to go look at it, but I didn't. There's been a massive amount of $100 calls being purchased, and for the end of Cal 21 and into Cal 22. Someone's making multi-million-dollar bets. These are probably Talibi and the Black Swan guys are buying big numbers, thinking at some point in time the market's going to say, wait a second, when we get back to 32 million barrels of of OPEC production, who's coming around the bend there?
Who's meeting the incremental demand after that?
Right.
But the other piece of that puzzle, which one would be watching, and again come back to the point of this week, the Fed talking about tapering and the challenge of inflation, because if inflation gets out of control, already we printed a 5% number now for May. This is not just slightly above the 2% average. We're talking more than double. Now the Fed posture that this is temporary. That's a big call, a high risk call. If you went into a casino and placed that bet, people would be looking at you. What's the consequence of getting this moment wrong on the Fed side for the energy markets, do you think?
I'm not sure the cart's out of the barn already. What can they do? They just printed $2 trillion. The only thing that's really or 2 trillion, 6 trillion. I kind of quit. I quit even trying to calculate the amount of bonds that the ECB has bought. They bought every single bond in Europe. I guess there's no more bonds to buy. If I'm not mistaken, that the Central Japan JGB owns something like 22% of the Nikkei, some crazy number of what they bought.
Wow.
I think the cart's out of the barn. I don't know what stops inflation. We just gave $2,000 to every red-blooded American. Go spend it. They're going to. And
Paul Tudor Jones, I don't know if you know who he is. Paul Tudor Jones, yeah.
Yes, I know Paul Tudor Jones. I used to work right back near that building right there for 20 years. So yeah, I know who he is.
Well, he made a call yesterday that if the Fed keeps ignoring inflation, he's going to be going all in on the inflation trade, and that is, buy crypto, buy commodities, buy gold.
Yep. I've kind of had a gold bug my whole life anyway, because I made the mistake back in 2008 or really back in 2005 that the Federal Reserve should not be printing money just hand over fist and buying every kind of bond. To me, it's always the misallocation of capital. You just can't print money and buy something and assume that's the right value. It just is illogical, and I don't think it makes any sense. The problem I think that we face in the world we've always lived in is we live in this market where it's a supply-demand world. It is driven by people driving and oil being produced. And if we go back, I think if Irene can show a chart, I threw up a chart on. I think it's on. That's this one. This one I think is
chart number 4. I think.
When I ran.
What does this tell us?
Well, I happened to run Merrill's. I ran Merrill's energy futures desk from all through the 80s and 90s, and we'd hire our people to go and be in Vienna during OPEC meetings with we bought one of those big old cell phones for him to call us. But I think there's two things here. When you look at what's happened the initial real OPEC move was 85, 86. That was the first time when Saudi said enough is enough. By the way, what do you think Saudi was producing in 1985? What would be your guess? What was their production level?
I'm going to say 15 million barrels.
No, 10 million. 10 million barrels. So they're 10, about 10, 11, right? They took it down to 2.8 million.
Wow.
They took it down to 2.8 million. And that was just before 85. At 2.8, they said, enough of this, we're taking it back to 10 million. And that was the initial price collapse from 32, 33, I think. It might have been, I think it was 38, down to 975, which was a remarkable move. But from then on, they seemed to manage it. When you look at OPEC production, then they kind of got along. There's a war in the middle there. There's another war. There was the point you just raised about when OPEC did the move in late 2000, late 99. They took the market up from 975, not coincidental, interesting, up into the mid 20s. But really, what happened after that was market forces. Market forces took over. Non-OPEC production continued to fall. So from 2002 all the way to the peak of $140, that was demand. That was demand catching up to supply, and it never really could. And it was only until the price went so high that we caused a worldwide recession, which affected demand, that we took the market back down again. But even at that point, OPEC was still kind of living in this dream world. They still were able to move things around and try to, they tried to manage it in their old way that they did back in 1985, which was have a meeting every 6 months, talk about what demand's going to be, and play around. Well, this time though, after the collapse of 08, 09, fracking came in. And for the first time ever, they had a marginal supply game to play. And that had never happened. Every other oil move that I'm aware of occurred over a price signal that first started the North Slope, then it started the North Sea. Then we got Brazil. We basically saw the West African crude started coming online. It was really this move of 2010 to 2014, where once again OPEC said, "What are we going to do? We want high prices." "Oh, you do? So do you?" And that brought on the fracking revolution. And again, what happened in 2014? That second Saudis tried to regain market share again. That blue arrow right there, that was the next collapse, right? And it was that collapse that took the market down, back down to a sub 30 low, $27, same thing. But the next time that changed, I think was, and this is really where we're at. And I think you're really sitting in the region that probably has the best feel for it.
And do you think at this in this period now, sort of post Vienna Agreement, when you expanded OPEC to include Russia and a handful of other countries, from 10, 12 countries up to 20, 22 countries, that OPEC Plus now have really got the driving seat back into this market? They've once and for all sort of elbowed shale out, whether it be the pandemic or their actions. But the outcome is that OPEC and Saudi Arabia is back firmly in the driving seat of the global oil market. Is that an exaggeration?
I think that is exactly where we're at. I think that is exactly where we're at. I think we're in a situation.
And so what would your advice be to them? How do they play this next phase? I mean, this could be the last decade, whether we're peak oil demand today or in 5 years. We're kind of in the window of 100 million barrels of oil. How should they play this next period? Because they're investing a lot here. UAE's trying to get up to 5 million barrels a day of production.
I'm not sure. I guess I would play it that way. I would look to manage it all the way up and try to get the price band back up to an $80 to $100 level. Two of the things that we experienced in the U.S. market was we experienced free money, and the formation of MLPs, which allowed for the easy investment in energy, which led to massive investment in the Permian, where it was all about investing in debt, and that's all been taken over. It's in one of our on the talk not too long ago on with you. ExxonMobil bought it, Chevron bought it, bought Occidental. Chevron bought Pioneer, still a big player there, but they basically have gone into the Permian, took out all the small players, and that's going to be their new Alaskan North Slope. Why not just manage? Exxon is going to manage its production in that location, raise it, not probably going back to 13 million barrels, I would imagine, for a while, unless something happens dramatically. But I would think the advice to OPEC is manage it to a higher price, because you're being told your oil is not going to be worth that, not to be valuable. You have to keep it up there. But the key is you cannot cause a recession. That's really the key. So there's probably this upper range. And if you go, we looked at one of the charts where we saw the market breaking out, getting up to 85, 89 bucks Brent, maybe bringing it back down to 65, maybe something they could manage.
But if you have it at coexisting, and this is where the Fed is so critical, if the $80 to $100 range coexists with zero interest rates and a weak dollar, then it's sort of free lunch for everybody. If the Fed gets it wrong, inflation and rates spike, then the problem comes.
But then the problem is not OPEC. Then the problem is that's not OPEC. Then that's everybody's problem.
Buy your canned beans problem.
Right. That is, and to me, this is the mistake of what the Fed has done this whole time. Volcker had it right, and I don't think we remember. When I got out of college, I should have bought the 20-year U.S. bonds at 17% and retired it. Retired before I started working, right? But it didn't occur to me then. But
it didn't seem like the wise thing to do.
It didn't seem like the wise thing to do. But you're exactly right, and I think I don't think they can play. I think they have to play what's in front of them, and that is manage their own position. The Fed will do what it's going to do. Inflation is going to do it. Do they contribute to, does high oil prices contribute to inflation? Maybe. But what do people think when they want to buy electric cars and they don't want to invest in oil and they want to have wind power? Do they not think that leads towards inflation as well, and other types of minerals and things? It's just, I'm kind of incredulous about that. So I think where we're at is we're different world. I think we're going to see prices go higher. And the only really thing I think will bring it down will be some kind of economic effect or recession that will really take the wind out of the demands of the market sales. Well,
Richard, we have to leave it there. We could talk on and on. It wouldn't be the halftime talk then. It would be probably the full time and the extra time talk. And maybe that's the next series we'll have to start. But Richard Redoglia, CEO of Matrix Global Holdings, sitting in California, thank you so much for joining us this week on Halftime Talk.
Thanks, Sean. Have a good night. Thank you.